Hey everybody, it's Renée Huse with Spire Mortgage Team, and today our webinar is called How to Get the Best Rate. So let's talk about the 4 points that we're going to discuss today to get the very best mortgage rate. First of all, we want to talk about your credit score, and it's not going to be what you might think. Next, we're going to talk about down payment and amortization. We have 2 strategies there. Then we're going to talk about market cycles and timing the market, especially right now when the market's very volatile. And nextly, we want to talk to you about choosing your mortgage broker wisely, okay? So let's start with credit. A lot of people are really worried about their credit score, especially at the pre-approval stage. They don't want us to do a hard credit check because they're worried about 1 or 2 points on their credit score. It's super important to know that in Canada, everybody with credit over 600 probably has access to the very best mortgage rates. Credit is broken down into 5 pieces. The 5 C's of credit, they're called: capacity, character, collateral, credit, and capital. So capacity is really your ability to borrow. So that's your gross debt servicing and total debt servicing ratios. So in Canada, the lenders like your total debt servicing ratio to be less than 44%. That means that less than 44% of your gross income is being used to service all of your debt. And they like your total debt servicing ratio. That means the ratio that of your gross income that goes towards servicing the debt on your property to be less than 39%. Lenders also love to look at your character. So they want to know on your credit bureau, are you paying your debts on time, and have you been doing that for a long time? Okay. So they're going to look at your cell phone bills, your credit card bills, and they don't like to see any missed payments. In terms of collateral, that's the house, that's the condo you're buying. So they want to understand, is this house in a good area? Is this house in good shape? Or is it a handyman special? Does this condo have post-tension cables or a special assessment? Or is it in good shape? Those types of questions come in when the lender is actually evaluating the collateral or the property that you're getting the mortgage on. Credit is the actual score, your credit score, and capital is your net worth or your rainy day funds. The lenders want to understand, do you have some rainy day funds? So all of that goes into determining a credit score for you, but also your credit profile, which is as important as your credit score. Some people have a credit score of 700, but they have bad character. They've not paid all their bills on time, okay? So really, we're always looking for your credit to be over 600, and it's ideal if your credit's over 680. One simple credit hit on a pre-approval should only be a couple of point reduction in your credit. So anyone that has decent credit should be able to get a proper mortgage pre-approval with a hard credit hit. Utilization is huge when you're applying for a mortgage and you really want to get the very best rate and have the most lenders that want to evaluate your file. Utilization means how much of my available credit am I using? So here's a trick. If you have one credit card with a limit of $10,000 and you need $10,000 in debt, what you don't want to do is put $10,000 on a credit card with a limit of $10,000. That's 100% utilization. The lenders hate that, and it means that you'll have less lenders that want to offer you a good mortgage rate. When it comes to utilization, the trick, if you need $10,000 of debt, is to apply for 2 credit cards with a $10,000 limit and only have $5,000 on each card. That's 50% utilization, and lenders love that. So that allows you to have more lenders that want to evaluate your file and will likely allow you to get a better mortgage rate because you have more rates or more rate sheets to choose from. The better your credit, the more lender options you will always have. Now, the other thing that can really increase your lender options is reducing your debt and increasing your affordability. So if your ratios are bumping up on that 44%, or even maybe you need an exception because your ratios are over 44%, then you're really decreasing the number of lenders that want to lend you money. So the fastest way to increase your affordability is always to reduce your debt. Let's do a quick note about debt. This is a little bonus slide for you guys, okay? So at your 44% debt servicing, total debt servicing ratio, or 39% gross debt servicing ratio, you can have about $400 a month in payments. We're going to call those free payments, okay? Because the total debt, that you can have on the house is 39% of your gross income, but they allow 44% total debt overall, okay? So you can have about $400 a month in payments. But an extra $700 a month in payments, so if your payments are $1,100, means you're decreasing your affordability by $100,000. Wow, that's insane. There's so many truck payments that are $700. So if you have that large payment, you are decreasing the number of lenders that might be able to lend you money if you have really tight debt servicing ratios. And that means it's less rates to choose from. A key point, if you're planning on buying a car around the same time that you're buying a house, buy the car next. Always buy the house first so that your debt servicing ratios are lower and you have access to the largest pool of lenders and rates, okay? Point number 2, down payment and amortization. So what down payments and what amortizations provide the absolute lowest mortgage rates? So when it comes to down payments of less than 20% provide the lowest mortgage rate. So that's a default insured mortgage. So you're getting the lowest rate, but maybe you have to pay the default mortgage insurance premium to get that rate. Maybe not always the best deal, but certainly the lowest rate. In today's market, at the time of recording, that's on April 30th, we have default insured rates around 4.89, okay? And if you have 35% down, you're not paying the default mortgage insurance premium, but that's another way to get the very lowest rate. We have 35% down rates right around 4.99%, okay? The worst rates always exist right at 20% down. Those rates are somewhere between 5.24 and 5.39 at the time of recording. What amortization gets me the lowest rate? It's always 25 years. If you have 20% down and you take a 25-year amortization, usually your rate is going to be about 10 basis points less than if you take a 30-year amortization. When we're talking about rates and down payments and amortizations, we want to talk a little bit about the different buckets that mortgages fall in. There's 3 mortgage buckets. Insured mortgages are for properties less than $1 million, and they're for somebody that has less than 20% down payment. So the clients that take insured mortgages are getting the best rates, but they are paying default mortgage insurance, often referred to as CMHC insurance. Insurable mortgages are also for properties less than $1 million, but the clients are not paying the insurance premium. Those clients have 20% down and they are taking 25-year amortizations. And remember, the property price has to be less than $1 million. That's another bucket of lending. That's the next expensive. And the most expensive is for conventional lending. So conventional lending is for somebody that's refinancing. That means somebody that's actually pulling equity out of their property for properties with purchase prices over $1 million and for somebody that wants 30-year amortization. So when your mortgage broker is asking you a bunch of questions about your mortgage, whether it's coming up for renewal or you're buying a new property, they are trying to determine what bucket your rate falls into so that they can properly quote you a rate. When you're doing online research, you want to make sure that if you see a rate at 4.79 on, a rate website, you understand if that actually applies to your specific situation. Otherwise, you might be getting your hopes up for a rate that isn't quite what you would qualify for or what your property allows you to qualify for. I want to make a quick point about 30-year amortization for insured mortgages. Just last week, we had a really cool announcement, and it was that the Government of Canada is going to allow 30-year amortization for default insured. That means mortgages with less than 20% down for new build mortgages starting in August. Now, you can't submit those deals yet, but if you are shopping for a new build this summer, be sure to reach out to us because I'm sure we'll have some more information. It's starting to come out from the lenders now. Our anticipation is that there will be a rate premium for 30-year mortgages. We don't know exactly yet, but it's certainly coming our direction. So if you have any questions about that as you move through this summer and you're looking at a new build property, feel free to reach out. Let's talk about timing the market. I get this question all the time. Can I time the market? The biggest answer that I give all the time is kind of. And I'm going to explain why, okay? Let's peel it back before I really get into my answer here about what actually affects fixed rate and variable rate mortgages and how they move over time. Fixed rate mortgages are driven by the Government of Canada bank yields. Variable rate mortgages are driven by the Bank of Canada's overnight lending rate. So this is what happens is we talk about the Bank of Canada announcements in the media all the time. And so clients call me and they say, I don't want to lock in my fixed rate mortgage because of the Bank of Canada announcement. Here's the thing. The Bank of Canada announcement is really not affecting fixed rate mortgages. That's just it's a miscommunication that the media is providing to Canadians. Fixed rate mortgages are very much influenced by the Government of Canada bond yields, and those bond yields are heavily, heavily influenced by the US Treasury yields. So fixed rates are far more affected by what's going on in the US economy than variable rates are. Variable rates are very much affected by what the Bank of Canada is doing with their overnight lending rate. So let's look at some of those current graphs. This is today's graph on the 5-year Government of Canada bond yield. You can see that since February, we've seen incredible volatility in the market. So we saw a dip down in February. We saw another dip in mid-March, and then a little bit of a dip at the end of March. And then we saw things take off as we've headed towards May, okay? Super important to understand that if you are buying a property or if you have a mortgage coming up for renewal, you can submit your deal to a new lender 120 days before you actually fund on that mortgage. So this is especially relevant for people with mortgages coming up for a renewal. If we have 120 days as a mortgage brokerage as a mortgage broker to look after a client's file, we have a ton of time to try to hit one of the valleys in the market. As you can see, fixed rate mortgages trade about 1.3% over this Government Canada bond yield, okay? So they're trading, in the low fives right now. Okay, somewhere between 4.9 and 5.3 is really where that rate band lies. And so what we're seeing is in this peak in this valley, we're seeing a 30 basis point spread over this period of time. And so what happens is that if we take on a client's deal in February and it's funding in June, we have all of this time to try to work with that client and reprice the deal to hold it at the lowest rates available in the market between the time we ingest the deal and the time the mortgage renews. So more time means more opportunities for me to reprice your deal and actually try to get you the very best rate. So what happens is if you call me with only 3 weeks before your mortgage renews is I might just fall in this space. There's not a lot of time for me to watch your deal for you and provide advice of how you could potentially hit one of these valleys, okay? Now, what actually affects variable rate mortgages? Variable rate mortgages are affected by the Bank of Canada's overnight lending rate. And you can see we were still increasing the overnight lending rate in 2022 and into 2023, but we haven't seen any increases or decreases as of April 2024. Now, the next announcement is in June, and we may see a decrease of 0.25. I don't think we will personally, that's my anticipation, but we may start to see some 0.25 decreases. The Bank of Canada's target rate is 5%, but bank prime, so the actual bank's prime, the like TD or Scotia or this sort of thing, trades in excess of this. So bank prime is currently sitting at 7.2. So 7.2 is bank prime, and then variable rate mortgages trade at a discount to that. So in Canada, most variable rate mortgages are trading between 6.2 and 6.5. So much, much higher than fixed rate mortgages. So what happens is if we see a 0.25 decrease in this overnight lending rate, we will see bank prime move from 7.2 to 6.95, okay? So that means variable rate mortgages will just trade, 0.25 lower. So still in the sixes. So let's actually look at what's happened with variable rate mortgages and fixed rate mortgages over the last few years. You can see that fixed rate mortgages are the red line, and traditionally fixed rate mortgages have traded over variable rate mortgages. But after the pandemic, we've seen this huge decrease in fixed rate mortgages, and variable rate mortgages have maintained a much higher value, okay? So right now we have a very backwards market. This makes me feel very nervous about variable rate mortgages because you are paying a huge premium to take a variable rate mortgage. Normally, we would be taking a variable rate mortgage when we are getting a lower rate. So we are willing to take the risk, right? We are getting the lower rate, so we're willing to take some risk. In this case, we are paying to take a risk. That is just inherently wrong in my brain. So I do worry about variable rate mortgages at this range. Now, I want to talk about a strategy that many clients are using because they feel they may be able to achieve a lower rate by taking a variable rate mortgage. They're using it as a placeholder to then lock in a rate. So what they do is they say, Renée, I'm not willing to take a fixed rate in today's market, but I think 3 months from now, fixed rates might be slightly lower on this curve. Maybe they'll be 4.5. So I'm going to take a variable rate mortgage now, and then I will call that same lender and lock in to a fixed rate mortgage 3 months from now when rates are lower. So if you believe rates will be much lower 3 months from now, a strategy could be to take this rate, this variable rate, and pay the premium, pay the 1.5% premium to have an opportunity to lock in at a lower rate in the future. But in terms of variable rates getting way below fixed rates, I think we're 2 to 3 years from that happening. So I'm not interested in paying a massive premium at this stage on these variable rate mortgages. I think it's bonkers. So you can use it as a strategy to lock in, a few months from now. But I think the massive premium for right now isn't necessarily where it's at. It's not my favorite strategy. If you had to ask me what I'm doing with my own money. So what is my answer when clients ask me, can I time the market? What's the timing I should do for my for my mortgage renewal? What I say to them is the biggest advantage that you can give yourself to get the lowest rate is time. It's put your deal into our system 120 days before it renews so that I have 120 days to provide advice, follow that rate for you, and try to time one of those valleys because rates always bump around. They bump around all day, every day, okay? So super key to give yourself as much time as possible. So what is our strategy when a client comes in? We do an intake call and we say to that client, there's 2 outcomes from this call. We are either going to put a pre-approval in place for you. So that's for a renewal or for a purchase. We hold rates for clients when they call us for a pre-approval. We put in a 120-day rate hold. We will either get a pre-approval with a rate hold in place or we'll be on a plan. And that might mean that you're not quite ready to move forward, but we have an action plan of how to get you there, okay? Once we have that pre-approval in place, there's 2 outcomes from the pre-approval. When you have a live offer or when your mortgage is coming up for renewal, if rates have increased, awesome. We nailed it. We put a hold in place. If rates have decreased, then hopefully we have an opportunity to drop your rate and secure a lower rate and lower your payments, okay? If you're on a plan, then there's a few opportunities that we have. We usually have a follow-up in 3 months and a follow-up in 12 months. So a few examples of why we might follow up in 3 months is that we might just need a quick credit cleanup. We might need to pay off some debts, or we might not quite be at that 120-day mark on your renewal. A follow-up for 12 months would be that there's something more significant going on with your credit. Maybe you need a significant saving plan to get a down payment. You've got a consumer proposal, a bankruptcy, something like that. But either way, no client leaves a call with me without a plan or a rate hold. That's what we want to see in every single call outcome. So here's some questions that come up when it comes to rate holds. So I would like to answer some of these. If you have more questions, just, pop into our DMs, leave us a note on this video. We'd love to answer those questions for you, okay? So how many rate holds can you actually send, and can you send different terms? So we have a few lenders that are awesome to work with when it comes to rate holds, and they do what's called holding the rate sheet. So if you're not quite ready to make a decision about 3-year fixed or 5-year fixed, no problem. What we can do is send your rate hold to a lender that allows us to hold all the terms from 1 year to 7 years, no problem. You've got all options available, okay? Also, if you're really unsure and there's a few different strategies, maybe you aren't sure if you want to put 10% down or 20% down, we have the ability to hold a rate with 10% down at one lender and 20% down at another lender. So lots of availability to bump things around. Another question is, what if my rate hold expires? Can you extend it? So I want to be really clear on how rate holds work on a purchase file, okay? If you have a rate hold in place, you have 120 days to get the keys in your hand, okay? Keys in your hand is key. It's not 120 days to write an offer. It's to put keys in your hand. So very important that you understand that that's the timing you've got. And if you think you might go beyond the 120 days and your rate holds expired, you have to be in touch with your mortgage broker. What if we've got a firm approval and mortgage rates have dropped? No problem. The lenders that we work with allow us to renegotiate the deals before you take the funds from the lender. And it's because we want to make sure that before you take the funds from the lender, we have exhausted as a pair, myself and my client, the ability to shop for the absolute lowest rate at every single lender. So lenders are very willing to renegotiate those rates down if we've had a rate drop prior to taking the money from the lender. Once you've taken the money, it's over. But if you haven't taken the money, we have the ability to drop that rate. So, do you have to hit my credit each time you send a rate hold? Yes. If we've hit your credit once in a 30-day period and then your rate hold has expired and it's beyond the 30 days, we would have to do another credit hit. Now, do we recommend hitting your credit every 30 days? Absolutely not. But if we've hit your credit and put a rate hold in place and something significant happens in the market and we are able to bring your rate down by 20, 30, 40 basis points, we definitely want to do that. So we'll reach out to you. We will get consent to pull your credit again, and we'll make sure that you're keen to bring that rate down and lock in a lower rate hold, okay? Let's talk about point number 4, the broker. So when it comes to working with mortgage brokers, there are some mortgage brokers that have access to a little bit better rates than others. And there's reasons that happens. So you want to be working with a mortgage broker that has lots of lender access. So there's many large brokerages in town that have access to all the credit unions, most of the major banks, a lot of the monoline lenders, lots of alternative lenders. Those brokerages that have access to tons of lenders are going to have access to the largest number of rate sheets. The more rate sheets, the more rate options, and likely the lower the rate for you. In terms of volume, that means how many deals is that broker or that brokerage doing so that they can actually get access to rate specials and extra ability to get discretion or work with pricing desks to bring your rate down. So if a broker or a brokerage is sending a lot of business to Scotiabank, they are going to have, more of an ability to negotiate with a lender to bring those rates lower. And then experience. So your broker should be able to understand rate holds and how the market works, trading within a band, looking for peaks and valleys, and working with you over that 120-day timeline to really be committed to revisiting the rate and bringing that rate down as much as possible throughout that 120-day timeline. So when you're looking to choose a mortgage broker, you want to work with somebody that's part of a large brokerage with great lender access, that's doing a large number of transactions, and that has the experience to understand how those markets work so that they can work with you over that 120-day period. So this is the sales pitch part, guys. How does it work at Spire? We do that initial rate hold for 120 days, whether it's a renewal or a purchase. When there's a live offer or a live mortgage renewal, we set a firm rate, okay, using today's best market rates or the rate hold. And then we do weekly rate reviews. So each Wednesday morning prior to possession or prior to mortgage renewal, we come together as a team and we usually have about 60 files on our desks that we go through and we say, hey, is there a better rate? Is there a better product for these clients? And then if there is, we go back and we renegotiate, okay? We will renegotiate with the lender and make sure that we've got the best rate available to you. Now, I want to be clear that it's to you, not necessarily in the market, right? Because every deal requires different rates. Every property requires different rates. So it's important that you understand the best rate available to you or to your specific file or to your specific product. We will look to renegotiate it and even look to move lenders if we have to really solidify the very best rates in the market for you, okay? So a note about restricted mortgages. I really want to just talk about this. It's kind of my last little point that I want to make before we wrap things up. Sometimes things are too good to be true. And often that fine print that you didn't read will cost you a lot more than 0.05% that you're saving in the long run, okay? So here's some things to look out for when you're searching online and a mortgage product comes up and you're not really quite sure why that rate might be a snip lower than what you're seeing somewhere else. Does that mortgage have a bona fide sales clause? That means that you can't refinance that property. Or if it's a variable rate mortgage with a bona fide sales clause, you can't pay it to zero if you wanted to, as variable rates were increasing the market. We saw some of that in the last few years. Does that mortgage come with a 3% prepayment penalty, meaning that if you do want to pay out the mortgage, you have to pay 3% of the original mortgage amount to pay it out? Is it a 6-month rate where you don't really know where you're going to be left 6 months from now? Are you taking a low rate on the front end to end up with something that could be a little scary 6 months from now? Or you might have a huge payout penalty to leave that lender if that 6-month rate doesn't work out. So those are some things that we're seeing, some things that are hitting our desks. There's a lot of fine print out there. So if you are really, really rate sensitive and shopping around and you want to understand those mortgages, make sure to reach out to somebody and ask all the questions before you sign on the dotted line. So thanks so much, you guys. If you have any further questions about this, we are always happy to help. Of course, you know where to reach me. My phone number is here, my email is here, and our website is spiremortgage.ca. Thanks so much.